Hello and welcome to Econoday Unplugged on Tuesday, the 12th of November 2019. Mark Pender is across the water on the US East Coast, and I'm Jeremy Hawkins here in London. So it's a pretty hefty period for economic data, with manufacturing very much in the focus in Europe and the US. We also have a broader assessment of economic conditions courtesy of GDP updates out of Eurozone, UK and Japan. Stateside first then. Mark, before we get to the data, I see Mr. Trump will shortly be giving a lunchtime speech to the Economic Club of New York. Financial markets clearly still preoccupied with global trade issues, and I guess with new intraday stock market highs pretty well as we speak, they seem to remain pretty optimistic. So do you think there's kind of a likelihood of any kind of positive news coming out of his address today, or is it still a case of wait and see?
Well, if there is, our colleague and Econoday staffer, Tony Mace, is at that speech and will be posting any breaking news as it happens. You never know what to expect. And, one day it's one thing and another day it's another thing with the Chinese and the U.S. negotiations. Last week, the Chinese announcing an agreement to roll back tariffs together, and then President Trump negating that over the weekend. So it's hard to say. I still think that the markets in general are holding an upbeat view on resolution of these issues, including European tariffs, U.S. tariffs on European vehicles. So it would take a big disappointment or a somehow collapse. We had that in August, if you remember. We had a breakdown in the talks, and that caused quite a reaction in the markets, but also in the business and consumer sentiment readings. But they have since recovered. And so the outlook, I think, is neutral to favorable. However, we are still seeing a decline in trade data, and so the effects are still there. There's no doubt about that. And as you mentioned, manufacturing is at that forefront. And so the effects of the tariffs that have already been put in place are playing out, slowing things down and really tilting the Federal Reserve policy, at least for the U.S., making for 3 straight rate cuts in a row. Whether we'll get a fourth, we don't know. But I think that's the setting right now. Also, Jerome Powell speaks tomorrow. He'll be talking on the Capitol Hill about the economic outlook. We do have a lot of information on what the Fed has been looking at in their recently concluded FOMC statement and press conference, Jerome Powell. So probably not a lot of big surprises. I think.
Can I ask you about the IP data Friday, particularly in the context of all this weakness of manufacturing? What's the consensus on this? What should we be looking for?
The Econoday consensus here is for further contractions. Actually, the consensus is for contractions that will match September contractions, pretty significant at 0.4 for overall production, and then 0.5 contraction for the manufacturing component, which is a major reading here. These are distorted. September was distorted by motor vehicles because of the GM strike. The GM strike did last through most of October. So there will probably be that effect underneath all this, however, is the capital goods sector, the industrial sectors. Those readings aren't broken out with the same kind of market interest that the durable goods report is, but they still have business equipment, and they still have high-tech readings in this, and they have been very weak. And that could, if those are weak in this report, that could be speaking on Friday's report to something more severe going on underneath. This is interesting because this is the U.S. industrial production. This would be for October. Now, China released their October report last week, and let me just call that. But the Europeans haven't. They've just finished releasing up their September data. Is that right?
Yeah, that's right. I mean, the European data can tend to come somewhat behind the likes of a lot of the Asian statistics, and certainly from your side of the world as well. And I guess with regards to that, the big news coming out of Europe last week was from Germany, where the goods producing sector officially fell into recession. So industrial production for the third quarter was down at a 1.1% quarterly rate. That followed a 1.7% decline in the second quarter. So that's technically equals recession, of course, and in September alone, it put the level of production at its weakest level in nearly 3 years. So clearly bad news for the Eurozone's largest economy. And just to show that it's not just Germany that's struggling from the goods producing side at the moment, Italy, they announced their September figures last week, and that duly left them in recession as far as goods production is concerned as well. And although France has actually managed to avoid recession in its manufacturing sector so far, it also reported a hefty third quarter loss that was down 1.2%. So if we stick that little lot together, on Wednesday, we're going to get the full Eurozone industrial production figures. And to be honest, it looks pretty well all but certain we're going to see Eurozone goods production now falling into recession. In fact, if we don't get any kind of back revisions, then the month-on-month figure for September would need to be up some 2.7% just to keep the third quarter flat. So in other words, Eurozone manufacturing very much struggling at the moment.
Well, before turning to the German GDP flash on Thursday, let me just correct myself on Chinese industrial production. They haven't released their October results yet. They'll be out on Thursday, Chinese time, which will be late Wednesday, U.S. time. But the consensus here is for slowing, continued slowing. And we had the Chinese trade data last week. And it showed the same general contraction and very, very deep contraction for the U.S.-China trade. The same kind of export-import contraction that we've been seeing at the U.S., for instance. But it's interesting because we've, in the past, have always marginalized the, reliability of Chinese data. But here it is. They're out first with a very important report, industrial production, and more and more, their data will be have a greater influence on the market in an increasing way, given the slowdown and the first signs of it. So it's kind of an ironic, interesting kind of a twist that it's these statistics that are going to be in sharp focus and apparently taken more than face value, taken as as credible as the U.S. or the U.K. or other data. Do you have any thoughts on that?
I think it's completely right. I think now we've got to a stage where we've been through a period during which China has been seen as being the kind of global engine keeping economic growth going. So anything that suggests, particularly in the light of the slowdown we've had stateside, anything that suggests now that China is slowing significantly as well is going to have a disproportionate impact upon markets. Now, as you mentioned, I think when push comes to shove, if you asked investors how much weight are they really going to attach to the likes of Chinese GDP, well, anything that moves as little as that does on a year-on-year or quarterly basis, I don't think anyone's going to fully believe. But nonetheless, it's the usual sort of thing with markets that they want the latest available data. Even if they don't fully believe it, it's more up to date than anything else, and that's what they're going to trade off. So certainly, I think you're right. The Chinese data this week, you mentioned we'll get the IP. We'll also get what retail sales as well later on this week, and they're going to be watched closely.
Well, I'm watching closely will be the German GDP flash.
Indeed.
On Thursday, along with the Eurozone GDP flash. Now, we've had other GDP numbers coming out of Europe. So what can we expect for these?
Well, the German one's going to be the key one because this will be their first estimate. The German figures, as good or as otherwise they may be, tend to come out somewhat behind the rest of the Eurozone. So we already had figures for the likes of Spain, France and Italy, none of which showed an actual downturn, but also none of which were particularly impressive. Now, Thursday, as you mentioned, we'll get the first estimate of German third quarter GDP. The Canada consensus there is looking for a second consecutive 0.5 3.1% decline. That's on a quarter-on-quarter basis. So clearly, were that to be confirmed, then Germany would actually technically be in recession. It may be only a very small one, but will the first time it's actually had back-to-back contractions in quarterly GDP since the turn of 2012. So it's the fourth quarter of 2012, first quarter of 2013. The last time.
Do they revise in the prior
they
quarter?
They can revise them, yes. So it's possible again that we could actually see perhaps a negative print for the third quarter and a second quarter downturn being revised away. So we'll have to wait and see. But I think however they're going to slice this data, the underlying impression now is that the weakness of German manufacturing, which as we've mentioned is now in technical recession, it's starting to have implications for how the rest of the German economy performs. Services we know are also slowing as well. And as you were talking about earlier on, I mean, put that against the background of all the problems we have with global trade at the moment, it really makes a pretty nasty scenario for Germany. And again, just underlines how sensitive or why markets become so sensitive to almost any kind of international trade data.
Well, now we had some UK labor data out.
Indeed.
Now it seemed to be mixed, and the headline or what you put up at the top of the report caught me. Let me just call that report up. What caught me was the claimant count has risen every month since February 2017. This is a count for unemployment, and it's risen for 2.5 years every month. What does that mean?
Well, it's got to be said that when it comes to the claimant count, it's not officially regarded as what they call a national statistic. It's a kind of an experimentary measure, but it's released much more up to date. So these are for October from the claimant count series, compared with the official data. These what they call the ILO, the International Labour Office statistics, and quite often, I suppose, in some ways, a bit like we can get in the States, where you get a big increase in employment, but the unemployment rate still goes up. We can get different stories being produced by the claimant count unemployment data on one side and what the ILO data are saying on the other. So the national statistics say, well, really, although we do have these claimant count figures, and markets, because they've looked at them for such a long time, still take them on board, you should really be focusing upon what they call the ILO data. So although, as you mentioned, the claimant count number has been trending solidly upward for a couple of years plus now, the ILO data actually showed, and this is for the 3 months to September, they take 3 monthly data here, showed a decline in unemployment of 23,000, an unexpected drop in the ILO unemployment rate down to 3.8%, which is a multi-year low.
Do they discuss this discrepancy? Or
not really. I think at the end of the day, the Office of National Statistics attitude is, well, look, the ILO figures are what we regard as a kosher statistic. The others are something which we put out more for information than anything else. They are measured differently, but I think at the end of the day, and certainly in terms of the media, the main press coverage now tends to be on the ILO figures.
Well, the other one is pointing. That's a terrible run, right? Unemployment rising every month.
It is, although it's got to be said that 3.4% unemployment on the claimant count number is still historically extremely low. Now, if we go back a couple of years or so ago, we did get down to the 2%, which were record lows. So it's been creeping up. But by and large, it's been creeping up, relatively slowly. So even as we speak, even on this claimant count basis, the jobless market, historically speaking, is still pretty tight.
Well, now let me ask you about average hourly earnings. What's interesting I see here is something I've seen in the U.S., which was a peaking a few months back and now a drop off. Is that what we're seeing at the U.K.?
It is, and it's important. I want to say just touch on the Bank of England from last week as well, and this is a good way of leading into it. It is important, I think, because in the context of policy, which of course is what investors are really interested in, one of the reasons why the Bank of England has had, and indeed still has as we speak, this so-called gentle tightening bias is because it believes that the labour market is tight enough to lead to an upturn in average earnings, which ultimately will feed through into inflation and push inflation above the 2% medium-term target. And for until I suppose the last couple of months or so, that had been generally speaking the kind of trend we'd been seeing in the earnings data. Certainly we had seen during sort of around summertime, there was quite a sharp acceleration in earnings, and a lot of people at the Bank of England then starting to jump up and down saying, look, told you, labour market's too tight, earnings are going up, the output gap's disappearing, we need to raise interest rates. Hence we had this tightening bias. They couldn't raise rates because of all the Brexit uncertainty, etc., etc. But what we appear to be seeing now, and it's been true over the last couple of months or so, is that the labour market is beginning to loosen a little bit. May not be a lot, but it's loosening a little bit. And the kind of acceleration profile we had coming through in earnings in the past is petering out. And indeed, we're now starting to see some kind of deceleration coming through, which of course makes it much less likely that the bank will have to tighten. Now, with regards to the bank, and I've got to touch on this from last week because, well, to be perfectly honest, I think it's all getting a little bit silly. So, in terms of the bank last Thursday, as people probably saw, we had no change in interest rates. So bank rate still stays at 0.75%, which surprised absolutely no one whatsoever, given we've got an election around the corner and we still don't know what's going to happen to blooming Brexit. And quantitative easing was left steady as well. But they also retain their central case scenario, which as mentioned is tightening bias, which means that rates will gradually move higher over the course of coming years. But despite all that, 2 of the 9 members very much unexpectedly signaled they wanted an immediate cut in interest rates. And not only that, at his press conference, Governor Mark Carney, well, he spent most of his time warning about downside risks to GDP and the need to carefully support the economy. Now, that's really left financial markets more convinced than ever, since they never believed this tightening bias was going to happen anyway. More than ever, they believe now that there's going to be, when we do get a change in interest rates, it's going to be on the downside. So, I guess the choice that rates are probably on hold into early 2020 because of Brexit and the elections. But, international investors and domestic investors now are going to be a lot more sensitive to unexpected weakness in the economic data than they have been previously.
Well, let's put on our financial economic communications caps. And what having a bias go in, or hold in one direction and having votes now splitting off into another direction. And then, as you were saying, Carney emphasizing the downside risks. There's a gap there between what they're saying and what they're implying, or what's being implied. And that really shoots down the quality of their statement and their reliability or their credibility when trying to describe their own policy. Am I overstating that?
To be honest, I don't think you are. I suppose if I back up a little bit and try to be a little bit fairer to the bank, you've got to say that ultimately this was their mid-quarter meeting when they have to update their economic forecasts. And at the moment, trying to forecast what's going to happen to the UK economy, since we don't know what's happening to Brexit, we don't know who's going to win the general election, we don't know what the election policy, post-election policies are going to be from any of the main parties, except the fact they're going to spend more. So it's kind of impossible at this stage to peer through the crystal ball to say what's going to happen. And the bank has been consistent in assuming that we get some kind of a smooth Brexit. It actually made some slight changes last week, whereby it's now assuming that the kind of smooth Brexit will come via Boris Johnson's touted deal with the EU, if he can finally get it through Parliament. And the bank's view is that were we to get a deal, markets would like it. It will give a big boost to sentiment. We might actually see, consumer spending, investment, and the general expenditure components of GDP all begin to pick up. And because the labour market is still tight, even though it's loosening, that could cause problems for inflation further out. But again, it's, as you say, it really doesn't sound too clever to be talking that kind of direction when you've got two of the 9 members voting to cut rates, and the governor himself still kind of hinting, well, he's a bit worried about what might happen. Yeah,
well, I guess if it wasn't for Brexit, then or the anticipation of a soft Brexit, they might have changed their bias.
It's possible. It's possible. And certainly, I think were they to suddenly believe, well, as we talked about in the past, anything can happen with Brexit at the moment. If it suddenly looked like it's going to be a no-deal Brexit, then I think that automatically they would lose their bias. They would introduce an easing bias, and it might even come out and cut interest rates, because they really are stacking the tightening view on the grounds that we'll get the kind of Brexit which leads to recovery in confidence and hence a recovery in domestic demand. Okay, let's round this bit off then with quickly on GDP. What do we get? The Japanese GDP third quarter numbers will be late out on Wednesday. They're expected to show a 0.2% quarter-on-quarter increase in total output there. That'll be down from 0.3% last time. So again, in line with what is still very sluggish Japanese economic growth and continued problems meeting their inflation target. As Mark mentioned, we're getting the Chinese IP data out, industrial production figures out also on Wednesday. We'll also get Chinese retail sales then as well. And also Wednesday, we'll get the Reserve Bank of New Zealand. They'll be announcing what they're doing with policy. And the general consensus, it's not, I must say, a completely firm one from what it looks like, but it seems that there's at least a small majority in favour of another 25 basis point cut in their official cash rate. That will put it down to a new low of 0.75%. That's following a 50 basis point cut in August, which is quite a big move by most central bank standards these days. And that would make for an accumulative reduction of a full 100 basis points so far this year. So again, just further highlight the fact that the general trend towards interest rates at the moment, irrespective of what Mr. Carney and crew might be saying at the Bank of England, remains very much on the downside. Okay, Mr. Pender, anything else to add?
No, I think we did it. We covered it.
Good. Excellent. That's what we like to hear. In which case, as ever, on behalf of Mark and myself, thanks as always for listening. Keep an eye on the old Econoday's global economic calendar to make sure you're fully up to date with what's going on. And we look forward to doing it again next week. Bye for now.